Good morning or afternoon, everyone, depending where you're at. My name is Joe Corio, Senior Vice President of URL Insurance Group, and I just wanted to thank everyone for taking the time today to be with us. For those of you who have done business with URL Insurance Group, we definitely appreciate your business and your support over the years. We know that you have a lot of choices of where to place your life, annuity, and health business, and we really appreciate you working with URL Insurance Group. For those of you who are new to URL, welcome. Thank you for taking the time to join us. URL is a full-service broker which offers a complete line of annuities, both fixed and indexed. We offer single premium life. We offer traditional life products. We have individual and group health products, a senior care division for MedSup and MedAdvantage, and also a group division. And I invite you to please take some time to check us out if you haven't seen our website. We have cutting edge website at www.urlinsgroup.com. Okay, we're very excited. We have a great program for you today focusing on single premium life insurance. And for single premium life is a product that has really become popular over the last few years. It provides solutions to clients' real needs, such as ways to efficiently transfer wealth, accessibility of funds, and it provides solutions for unexpected medical costs, as you'll see as we go along here. We're very happy to have with us today one of URL's primary partners over the last 15 years or so, Equitrust Life. Equitrust is and has been one of our top annuity companies, providing a full line of fixed and fixed indexed annuities, and they also feature one of the industry's best income riders on their indexed annuities. Well, today, in addition to the annuity, I'd like you to be aware that Equitrust is a leader in single premium life as well, and they have what I consider one of the best single premium life plans in the market. Between the product benefits to the client, the compensation to the agent, and the ease of underwriting and doing business with Equitrust, it's pretty hard to top their products. Now, we're very pleased to have with us today Matt Stiles. Matt is the Senior Sales Consultant with Equitrust Life, and Matt is going to review the Equitrust single premium life plans for us, and he'll give you a nice presentation so you can see in person what great products Equitrust really has. At the end of the session, we'll answer any questions that the attendees have, and you can ask questions by typing in on the pane on the should be on the right side of your computer screen. There's a question box. Just click on that, type in your questions. We'll answer them all at the end. And of course, the support that URL provides for agents as far as proposals, product information, case scenarios, reviewing them. We're always here to help you, and our number will be on the screen at the end. So right now, without further ado, I'd like to turn it over to Matt. Matt's going to take you through here, and looking forward to seeing Matt's presentation. Matt, take it away.
All right, thanks Joe. Yeah, Joe mentioned URL has been a great partner with us over the years, all the way back to the beginning of Equitrust, and I'm really excited about the products we're going to be discussing today. It's our Joe, you still on there? Got some feedback. So
I'm on here, Matt.
Okay. Yeah, it's just had some feedback on the speaker, so sorry about that. Yeah, we're excited about the two great wealth transfer products that we got here at Equitrust. Rolled out the Wealth Max product about 5 years ago, and over the last 5 years, it's continued to grow as single premium life products have grown in this industry. It's a great alternative for clients that have money that they're not needing to retire on, that they might need in case of an emergency, or they just want to create instant wealth transfer to their beneficiaries tax-free. And I'm going to really cover the in-depth on how that product works, where you can position it, and why our product stands out to the other single premium life products in the field. First, want to just mention um, why single premium life? What's a client buying it for? Basic, simple answer is it's an effective means of wealth transfer. I mean, that's the first objective they're going to want to purchase it for. The first goal they're trying to meet is this assumes a 60-year-old female. She's got 50,000, just what we maybe call lazy money, bank CD, something that maybe she'll need rainy day. She just doesn't really need it to live off of. She can instantly turn that 50,000 into a $103,500 death benefit, tax-free upon her death. So instant increase of her estate into the death. Another main objective, that same 50,000, 103,250 for certain health conditions. So she's worried, hey, I don't need this money now, but nursing home, chronic care, something happens to me health-wise, I might need that money. So this product will instantly turn that 50,000 into 103,000 for those certain health conditions. So those are two basic reasons of why a client's looking to buy single premium life. But then you run into that objection from a lot of agents, especially annuity agents. My client doesn't want to go through a fully underwritten. They don't want the paramed coming out here. We want to make this a simple investment for them on money they're not needing at this time. Well, that's where we at Equitrust have gone and done what we call a simplified issue. It's a phone interview and an app. There's no paramed. Standard to table 4 is what it states here. Basically what that means is, generally speaking, if a client's healthy enough to get approved through like a table 4 on a fully underwritten product, they're likely going to get approved with us. We have a pre-qualification chart is on the agent guide. It's just kind of an outline of what to look for. Hard issue in the last 7-8 years or something, you might want to get a little more information on that. Just kind of gives you things that are going to cause a problem or might cause a decline. Obviously, there's a health questions on the app. There's about 12 health questions on the app. They're pretty straightforward, not too in-depth there. Any yeses don't necessarily mean a decline. It just means they're going to need a little more information and an explanation on that. Phone interview. Most agents just do it at the point of sale. Complete the app, call in and do the phone interview. Phone interview repeats a lot of the same questions that are on the app. Right now, our phone interviews are running about 18 minutes on average, so not too painful. If you don't have time and the agent doesn't have time at the point of sale, you can always mark that to call out to your client to get that done at a time that's appropriate or when they can do it. And obviously the big one, no exams or fluid draws. So no parameds coming out there a week later to poke at your client and don't have to, you can free them from that. APS at underwriter discretion. If there's something borderline, full heart surgery 7 years ago, we don't have a whole lot of information on it, how the follow-up's been, the client's not really sure, hey, we're going to want to get an APS to get a little better idea on that. So occasionally we'll have to order them. Right now I think we're ordering an APS on about 10% of our cases, just to give you an idea. Obviously that's going to take a little longer in the process if we do have to go get a physician statement. Otherwise, if everything else is at the underwriter that they need, decision within 48 hours. I'm generally seeing them right now at about 24 hours. App and phone interview, app faxed in on Monday, phone interview done. Usually by like Tuesday afternoon, the underwriter will shoot out an email that says, hey, Mr. Smith's been approved. We're just waiting for funds to issue. So pretty straightforward on the underwriting process. And real-time notification, as I mentioned, an email goes out, it's posted on our website. Try to keep the agent up to date on what's going on their cases. So we've tried to simplify the process, that underwriting process, for the agent that's a little skeptical sometimes on life insurance. Just some standard features on the Wealth Max bonus. Just kind of want to touch a little bit of the general features on the product. Issue age is 50 to 85. There's no backdating to save age. So we basically have to have the app in-house before they turn 86. If we end up having to order, a physician statement, the underwriting takes them past when they turn 86, we're okay there. Basically, we'll hold it. The check's going to hold it too if it comes in, and then we issue it later. But no backdating. If they're only 49, you got to wait till they're 50 to submit it. So it's pretty straightforward on the ages. There's no leeway there. Single premium, 10,000, max of 750 face. So it depends on their age, how much we'll take in premium. You can always get a quote from us or URL on that if you think you're going to be coming close to that 750 face. They do stick pretty close to the 10,000 minimum premium on the single premium. Guaranteed death benefit to age 121. So if they don't take any loans on this, they're guaranteed. I mean, it could become overloaned is why I mentioned that. But otherwise, it's guaranteed, that death benefit. You can show them in the illustration, hey, you're guaranteed this all the way till, obviously likely till they die, or age 121. 10-year declining surrender schedule. So the surrender charges are pretty light too. They start at 10%. You know, if they got some nice accumulation value and something comes up, you know, year 6 or 7, and they actually have to cash it in, the surrender charges aren't going to be too painful for them. Likely not going to come into play on this type of product, but it is client friendly there also. Your index accounts are available, and I'm going to give you those cap rates. We've seen obviously some really nice returns over the last 3 to 4 years on the S&P strategies on the index. This is a big one, 12% premium bonus added right away. So right away they're getting a bump up in the account value, which in turn is giving them a bump up in the death benefit because, you know, the corridor, as it's called, you know, in the life insurance industry, you're required to have so much death benefit above what their account value is. So that 12% is going to work for them right away, which is nice. In there, they could see that death benefit increasing right away into their account value also. And this does have a return of premium guarantee. And really that's just a nice, what that means is they give us $50,000, something comes up, they don't need the coverage anymore, family emergency, you know, whatever it might be. At any time, they'll get at least $50,000 back from us. It's a money back guarantee. You know, you're sitting across from that client. They might not have a need for the money at this time, but it's nice as the agent to have that in your back pocket to say, hey, at the worst case scenario, you'll get your money back. You know, all else fails, you can at least have that back, which is a nice thing to have at the time of sale. A few things on the liquidity. 5% penalty-free withdrawals are available each year, a little different than the 10% we offer on annuities, but still a 5% penalty-free withdrawal. You are only allowed one penalty-free withdrawal each year, and then it obviously proportionally reduces the death benefit. So if you take 5% of the account value out, it's going to decrease the death benefit by 5%. As I mentioned, the Wealth Max does have that return of premium feature, so if they have to surrender it, it just means their surrender value is going to be no less than their premiums paid at any time. Accelerated death benefit rider for living benefits. That's obviously a big one, a big selling point. There's a couple of states, Florida and California, that don't have it, a couple bigger states, but accelerated death benefit rider is approved in 46 other states. So, and I'll cover how that works too. I'll give some examples of the accelerated death benefit rider. Here's the current cap rates, and right away annuity agents are saying, wow, 8% point-to-point cap, which we've seen some obviously good returns. Obviously on a life product, you do have a cost of insurance and a policy expense charge on there. So a lot of times they're not getting an 8% total return, but we've seen point-to-point cap clients, you know, getting credited 6.5%, 7%, depending on what the fees are. And then obviously these other two strategies, the 1-year monthly cap at 3, we've seen some really nice returns with some great upside potential there. And we have kind of a unique strategy, a 2-year. It takes a monthly average, a 24-month average of the S&P. There's 100% participation, no cap. So whatever increase that 2-year strategy has, the client's going to get it. So we've seen some double-digit returns, obviously, over the last 3 to 4 years on that 2-year strategy also. Here's what we're currently illustrating them at. The illustration software, it's actually, if you pick the point-to-point, it illustrates at 5.02, but 5% basically. They do like a 20-year look back and what the client can kind of historically expect to see on these strategies. That 2-year, and obviously credits only every 2 years, so it's a little over 5%. So basically we're illustrating all these strategies right around that 5%, which we've seen clients actually outperforming the last few years. But you look at it over the course of like a 10 or 20-year period, that's about what you can expect historically on what's happened with these strategies. Want to touch base on the living benefit rider. That's obviously a key factor on why these products have been so popular and so successful for us. It's automatically added. There's no charge for this. As I mentioned, it's approved in most states. Terminal illness. Client becomes terminally ill. They basically get information from their physician to us that the client has basically 12 months or less to live. They want the money now. They want to spend it while they're, they want to actually give it to their kids maybe or do something with it. They get 95% of their death benefit in a lump sum. So basically 95% lump sum on the terminal illness, which is a nice feature. Nursing care confinement. They go into a nursing home. If it's expected to be a permanent stay in the nursing home, they get us that information. They can get 100% of the death benefit paid out over 3 years. So whatever their death benefit is, we'll take that amount, divide it by 36 months, and we'll send it to them. They don't have to spend it on the nursing care. Maybe they already have a long-term care policy. They want to do what they want with it. It's a reimbursement to the client, not paying the nursing home. Or if they want 85% lump sum death benefit, like I mentioned, maybe they already have something paying for their nursing care and they just want to spend this money on their own, they can get a lump sum death benefit of 85% of the amount. Chronic care would be unable to perform 2 of the 6 daily activities of living. Maybe someone's taking care of them in their home, or they just become chronically ill. Same benefit if they take it out over 5 years, they get monthly payment, they can get 100% of the death benefit. Or if they wanted in a lump sum in that scenario, they'd get 75% in a lump sum for chronic care. So some options there on the living benefit rider. I'm going to give you some examples of that here too. This is, we got a client, Betty. She's got $50,000 sitting in a bank CD. It's earning 2% down at her local bank, which is actually probably better than most banks are paying right now. But Betty, non-smoker, age 60, her objective of this money, leave this money for her 2 grandkids when she dies. Her concerns, well, potentially some health-related things come up, medical costs, nursing care, etc. You know, what are her options? Her general, I mean, she would have a lot of talk, but her general options for keeping this money safe: leave the money in the CD, maybe purchase an annuity and get a fixed rate now at around 3%, or purchase the Wealth Max policy. Here's a nice little piece that shows on that CD how much she's going to give her grandkids if she passes. Something happens in the first year, the grandkids are obviously, the CD is going to be right around 50,000. At 2% after 10 years, 57,884. 20 years, it's grown to 67,494 at 2%. The annuity at 3 is obviously doing a little bit better. The Wealth Max, guaranteed right away, that 50,000 is given her kids, her grandkids, whoever, $103,000 $500 death benefit. After 10 years, that's the minimum, so that's going to be at least that. 20 years, obviously we're still beating it. Let's assume, let's see, what is this? This shows a 5.5. We probably need to update this to 5, but this is based on 5.5 illustrated rate, which actually we've been seeing returns like that over the last 4 to 5 years. But assuming 5.5, after 10 years, that death benefit's grown to 129,000. Her 50,000 after 20 years, so at age 80, that's death benefit's going to be worth 145,781. If she needs it for nursing care, she gets the 145. She passes away, that's what goes on to her kids tax-free. So just as a point of reference, that CD, I was told it would take 43 years to grow to 145,000 at 2%. So kind of a nice piece there to show the power of that instant death benefit and the increase over that time. Let's assume she goes into nursing care, chronic care, something happens to her health-wise. That 50,000 terminal illness, we're going to give her a check for $98,075 for terminal illness. Generally, when that's filed, I'm not a tax advisor, but that should be tax-free on any of these because we're triggering the death benefit. For nursing care, she wants a lump sum. That $50,000 is going to give her $87,725, or most of the clients are probably going to take that out over 36 payments for 3 years, the $2,868, which if you add that up, it comes out to the $103,250. Keep in mind that's the minimum amount. I mean, if the death benefit's higher, they're going to get a higher amount. Minimum amount for chronic care in the same scenario, you'll see the lump sum a little over $77,000, and then for chronic care for in-home, maybe to pay for whatever she needs for expenses, $1,720 a month for 5 years to her. If she passes away prior to those 5 years, whatever's left in the death benefit is going to be paid out to her beneficiary. Obviously, those payments are going to be reducing the death benefit, but she'd still have the death benefit there until it's fully paid out. What if Betty has an unexpected expense, roof leaking, damage to her car, or as this photo shows, maybe both at the same time. But anyway, something comes up in life, you got the return of premium guarantee too. So if she comes up with an issue, she needs her money back, it's kind of a nice way, as I say, for an agent to be able to say, hey Betty, emergency comes up, we'll at least get you your money back. So That's the return of premium guarantee. So kind of in summary on the Wealth Max, we like to say, if you're taking nothing else from this, what's your client getting? You're getting that guaranteed death benefit, instant estate growth, tax-free, the living benefits for chronic care, nursing care, whatever it might need while she's still alive, health-wise, and then also just the safety of the money, the return of premium, the low surrender charge schedule, just the safety of knowing you can have access to the money is what this product can offer your clients. Just one other thing I want to mention on the Wealth Max, we get questions, hey, can we get a lot of these slides and that? We do have some great points in this show book that we have, positioning on the product, some examples, similar examples to what I just showed you that are client approved. So if your client's not quite understanding something, it's a great way. This is easy to read, big print. It's about 15 pages. You can just flip around. As an agent, if you're going to make a sale or looking to make a sale on this product, I would carry this show book with you because it's going to help you with some of those questions, examples, market comparisons, that sort of thing. URL can get this to you. You can order it on our website. We'd be happy to get them sent out to you. So then we were selling a lot of this Wealth Max. We had agents come to us and say, gosh, I love that Wealth Max, but Betty that had that $50,000 in her CD, she's got $100,000 in an IRA and has no need for this money at all. But we can't move it because she can't take that tax hit right now. So what can we do with that qualified money? That she just wants to move this on for wealth transfer. That's why we created our newest product. It came out, started selling it in January of this year is when we first had our Wealth Pay sale. Wealth Pay, it combines a single premium immediate annuity to pay for an index-linked whole life insurance product. So basically, the application is buying two products with us. You're buying a SPIA, and then we're going to internally use that SPIA to fund a fixed premium whole life insurance product. So the annual SPIA payments, they can choose 3, 5, or 10 years. So they can spread out the tax consequences over 3, 5, or 10 years, just whatever will work for them as far as what they want to do tax-wise. As I mentioned, taxes are spread over each SPIA payment instead of all up front. And I'll give you an example of that here in a moment. Immediate income tax-free death benefit at issue. So the first payment goes over right away. You're immediately funding a tax-free death benefit as soon as this is issued. Commuted value of the SPIA in the event that the client dies during the premium payment period. I've seen some competition of ours that maybe they have a higher death benefit, like on their 5-pay, but if you read the fine print, the client dies in year 3, that SPIA is gone. They'll get the death benefit still. With us, they're getting the remaining SPIA payments, the beneficiary would. Obviously, those would be taxable still because they haven't been taxed, but they get the remaining SPIA payments in a commuted value and also the death benefit tax-free. So and we show that in our illustration too. Just thought I would point that out though because it is a nice feature. Standard features on the Wealth Pay that we have, 60 to 80. We chose 60 just to avoid the under 59.5. That way we don't have to mess with that. But 60 to 80 as far as the issue ages. The minimum premium's a little higher because we're funding over 3, 5, or 10 years, so we raised that a little bit. Accelerated death benefit riders on there. It does have the same 10-year surrender schedule that the Wealth Max does. It's funded by a single premium immediate annuity, as I mentioned. The 3, 5, 10-year payment options, so the client can decide, how much taxes they want to pay each year. And then there's one app. That's one of the keys that we wanted to make sure we had. Hey, if we're going to do this, we got to make it simple for the agent. There's one app. You'll get two policies together, when we mail it out. One will be the SPIA, one will be the life product. But the one app, same simplified underwriting as the Wealth Max. So I talked about the process on the Wealth Max. We're going to have the same phone interview, same standard through Table 4 simplified issue on the Wealth Pay. Here's just a very simple piece on why you'd want to buy this. It's obviously you're going to be looking at IRA money. There's potentially on an annuity that, say the cost basis is real low and they have a ton of gains on a non-qualified annuity, then it might be a good option too. But really, if there's not much taxable gain, you're going to want to buy the Wealth Max because it's giving them more bang for the buck right away up front, larger death benefit. But this product is designed if they can't afford the tax consequences on IRA money to take that big hit all at once. So this piece shows $50,000 in a 401k. We're going to pay a SPIA. She's chosen a 5-year payout here. We're going to send $10,660, which is actually a pretty nice little return on a 5-year SPIA if you've shopped SPIAs lately. But anyway, we're taking 5 payments of $1066 and putting that into the WealthPay Life product. So the client's going to get a $1099 each year at the end of the year for the $1066 as opposed to $50,000 all up front. So she can manage that at tax time a lot more sensibly. And that is instantly going to buy her $95,000 death benefit, that $50,000. So she's going to get that right away. So that kind of simplifies why you're buying this. You know, she doesn't need the money. Hey, I want to move this from a taxable. When I die, I don't want my kids to pay the $50,000 in taxes. I can afford to pay it now. Let's go ahead and do it over 5 years. That's why you're buying this. The living benefit rider, it's automatically included. It's a little more complicated. I'm going to basically say they want to hopefully wait, if possible, until the payment period's up. Like if they do a 5-pay, let's say they do go into the nursing home in the 4th year, you want to try to wait till that 5th payment hits and then trigger it, because then it's going to be the same as the Wealth Max. You know, those same great features. You're getting less for chronic care. You're only allowed to accelerate 25% of it if it's during the premium payment period, and this is only a one-time election. Obviously, you become terminally ill, you can't control that. You can get 75% in a death benefit if it's during the premium payment period. If it's after all the payments have gone into the life product, it's the same as the Wealth Max. So a little confusing there, but it shows that on the agent guide and the client brochure. But it's still there if they need it. Something comes up health-wise, that's the big thing you can tell your client. You know, if you become chronically ill, you can access this money. Ideally, hopefully after the premium payment period. Say that 3 times fast. But anyway, hopefully it's after that time period's up for the client, because they're going to really reap the benefits more on that. Here's the current rates we're offering. Obviously very competitive, some nice returns. And the illustrated rates, a little bit higher. It's a look back. Obviously when you got higher caps, the illustrated rate's higher. So really some great returns on these, obviously, and some great cap rates. We don't have the 2-year, but we have a 1-year, 12-month average, 100% participation, no cap. So whatever the S&P does, we take a 12-month average and compare that to the starting S&P. But whatever that does, the client's getting 100% of that gain, which is a nice way to sell it to the client. So just want to wrap it up with a couple more things and then see if we got any questions here. A couple things to take note on the WealthPay. The Wealth Max, since it's a life product, there's no product training required. But on the WealthPay, it does have that annuity component to it. So if you're selling the WealthPay, there is a training. It takes about 20 minutes online, no test or anything. But we just hate to have an app come in and have to call out and say, hey, you need to do the training or we can't accept this. So get that knocked out if you're even thinking about writing this product. It's pretty painless. Liquidity limitations during the premium payment period. I mentioned that briefly, but also if they take a 5% withdrawal out of the life product, those SPIA payments are then going to overfund. We can't have that. We got to refund then each year part of their SPIA payments, because the policy is not designed to be able to add more or less premium to it monthly. So you want to, as an agent, just make sure your client's aware of the liquidity, limitations while it's being funded, while the life product's being funded. And they can have tax withholding too. So in that example with the $10,000, we can withhold taxes on that too, just what we mentioned, to make it even less painful at tax time for the client. We can withhold on the SPIA payments for them. Kind of want to wrap it up here with sources of funds that we're seeing come into these life products, because an agent says, what type of money are you seeing? Where's the money coming from their clients are using to fund these? It's obviously from all sorts of sources now, but the main ones, bank CDs. That's a lot of money we're seeing. Banks aren't paying much, but the client likes the safety of the CD. The agent's able to show them, hey, with this Wealth Max, it's still, accessible. You're increasing your death benefit. Obviously, that lazy money, as it's called, savings account, money market, is obviously another big one. Annuities. Obviously, if they want to move out of it and they're not needing it for retirement, agents that are out there selling annuities, if you're coming across clients that have no need for retirement income or any income off of this annuity at all, you're kind of doing them a little bit of an injustice if you're not showing them the life product. If they're reasonably healthy, why not give their beneficiaries a tax-free death benefit and offer them these other great features? So annuities are a great source of funds also. Life insurance policies, that one's a little bit trickier, but if you got a life policy that they're paying into, continuing to pay into, and it's reached a point where, let's just take the cash value of this life and purchase a single premium life product, that could be a lot more beneficial for the client just to move out of a policy that's not performing or they don't want to continue to make their monthly or annual payments to. And then now number 5 with our wealth pay product this year, qualified funds, 401k, 403b, IRAs that, hey, I don't even want to take my RMDs on these. Hey, let's move it into this wealth pay. You don't have to see the RMDs anymore, and your beneficiary is going to get a tax-free death benefit. So those are the sources of funds that we're obviously seeing coming into these. The website I'm not going to touch a whole lot of detail with. I just want to mention that pending business, you can go out and see any business you have. You could see notes from our processors out there as an agent. URL is a good source too for you. But as an agent, if you want to go out and just get some materials or something, our website I think is very agent friendly, easy to use. So just thought I would mention that. The last slide, the only thing I really want to point out here is that email at the bottom. When I'm at my desk, which is most days, that lifesales.support, I'm the one checking that about every 15, 20 minutes or so, just seeing what's coming in. It's a good source for both the agent and URL. If you got maybe a borderline client that says, do we want to take the time to submit this or not? They've had this issue and they're taking these medications. Shoot me an email to that life sales box. I'll get that right over to the underwriter. They'll take a look at it and they'll say, yeah, we could still consider this client, or no, I wouldn't submit that because that's going to be a decline regardless of what we see. So it's a good way to kind of touch base with us ahead of time if you want to get a feel for a client on what might be acceptable or what might not be. So I encourage you to use that, or give us a call. We can do the same thing on the phone with you too. So with that, I want to hopefully bring Joe back on if there's any questions. And also here's URL's number too on there in this last slide if you want to contact URL. Like I say, they've been a great partner with us.
I think I'm back on. Can you hear me, Matt?
Yep, I can hear you, Joe.
Yeah, good. Yeah, one question that came up. What do you see as far as underwriting, the percentage of cases that get issued or approved, I should say, right off the bat?
Last time, well, as I mentioned, we're seeing about 10% have to get a physician statement. If the premium's over $300,000, we automatically order it. So that's a portion of that, obviously. Last time I looked, I think we were at 82% approved and 18% decline.
Okay.
And a lot of those declines are ones that they're just not even looking at the agent guide. I mean, I don't want to try to say it's not the underwriter sometimes, but the agent sometimes is not doing, but right now we're got about 82% approval last time I looked.
Okay. I don't see any other questions, but URL is always available to answer your questions. And I'd just like to say what we're seeing is a lot of business that is coming from CDs. A lot of times when people talk about annuities and you ask, well, what's the purpose of this annuity? And they say, I just want to leave it to my beneficiary. This type of product provides them much more benefit for their beneficiary. It still provides them access to their money, whether they want it all back or just need a little something to fix their car, like you mentioned, Matt. So it really is a great alternative for you guys and girls who are doing annuity business. And I think you'll like the underwriting, the ease of dealing with Equitrust, and the compensation that you'll receive. So if there are I don't see any more questions here, Matt, so I think we'll wrap it up. I'd like to thank everybody for taking a couple minutes out of their day today. Again, URL will be here to help you. I want to remind those on the line we are closed tomorrow because we are moving, but I will be checking my voicemail and my emails via remote. So don't hesitate to get in touch with me. It's Joe C at urlinsgroup.com, or the 800 number on your screen. My extension is 111. Matt, thank you very much for your excellent presentation. We appreciate it, and we appreciate the support and the partnership that Equitrust has shown us over the years, and we look forward to doing a lot more business with you. Thank you, everyone, for taking the time out today, and with that, we'll close it up. Have a great day.
Thanks, Joe.